tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Welcome to the Power of Zero Show. I am your loyal and faithful host, David McKnight. I'm the best-selling author of The Power of Zero, A Look Before You LIRP, The Volatility Shield, and most recently, Tax-Free Income for Life. If you haven't had a chance to write a review on Tax-Free Income for Life on Amazon, I would be honored if you went over and did so right away. If you are looking for someone to help you navigate the pitfalls that stand between you and the 0% tax bracket, head over to davidmcknight.com. We'll hook you up with someone who's a member of our elite POZ advisor group, which means they've been trained, qualified, and vetted by yours truly. And if you are an advisor who wants to transition your practice to a Power of Zero style practice, head over to powerofzero.com. We'd be happy to chat with you. All right. Today's podcast is going to be based off of an article written by Bobby Samuelson called the Section 7702 Christmas Miracle. And the link to that will be in the show notes, by the way. Now, a lot of us, particularly those who are in the industry, have been watching with interest AG 49, which has really prevented us from really showing illustrations that correspond to what these LIRPs, these life insurance retirement plans, have done in the past. In other words, due to interest rate, low prevailing interest rates, and a number of other factors, the federal government has really clamped down on us being able to show the robust rates of return in these policies that would reflect precisely what they've grown in the past and what we feel they can grow in the future. So really, that's been the talk of the industry, particularly in the LIRP circles. Something happened in the waning hours of 2020 when the Consolidated Appropriations Act was passed into law. And this literally was at the 12th hour when this happened. And it amounts to what Bobby Samuelson calls a Christmas miracle. The change that was introduced will be immensely positive for LIRPs and will position LIRPs to thrive in an environment of low interest rates, which is what we are currently mired down in. First of all, let's talk about what Section 7702 of the IRS tax code is. That's the section of the Internal Revenue Code that defines life insurance for tax purposes. Sometimes you'll see people in our industry that calls the LIRP a 7702 plan. What they're referring to is the section of the tax code, the IRS tax code, that governs the tax treatment of life insurance. So this is what we know about Section 7702. It literally has not been changed in decades. Okay, it has continued to persist in its current form for 20 to 30 years. Okay. Now, the tax limitations in Section 7702 as it relates to life insurance are calculated by asking a simple question. At what premium level will the policy stay in force based on the life insurance expenses and an assumed interest rate? So this is where it gets really interesting. So Section 7702, baked into that code, was an assumption that your cash value would grow at 6% if you had a guideline premium test single premium, or 4% if you had a CVAT, MEC, or a guideline premium test level premium test. Okay. So let me distill this down into layman's terms. When you put money into a life insurance policy, there is a relationship between how much money you can put in, how much money you can contribute, and the amount of death benefit that you're purchasing. Okay. So the IRS says that you can only put so much cash into these life insurance policies because they want to define how much tax benefit you can really get. This formula that they've used historically has worked under the assumption that you can get either a 6% rate of return on the money that you contribute to these policies, if it's a guideline single premium, a GPT single premium test, or 4% if it's CVAT, MEC, or GPT level premium test. So in other words, they're assuming that you can get either 6% or 4% rate of return, depending on the way that you structure the policy. And that interest rate that they've hard-coded into Section 7702 governs the relationship between how much money you can put in to the policy relative to how much death benefit you have. It's a little bit complex, but I'm trying to distill it down into the most understandable layman's terms. On page 4,923 in Section 205 of the Consolidated Appropriations Act that was passed into law, literally at the 12th hour, in the waning hours of 2020, we find the allowance for a 2% hard-coded rate for 2021, and beyond 2021, it allows for a floating rate, which will be keyed to prevailing interest rates at the time. Okay? So in other words, we're no longer required to live by that 6% and 4% interest rate assumption. We're now able to, for the year 2021, use a 2% interest rate. And in year 2022 and beyond, that interest rate can ebb and flow based on whatever the prevailing interest rates are at the time. So how does this impact the LIRP? How does this impact a life insurance policy that people are using for accumulation purposes? In other words, they're building money up with the expectation that somewhere down the road, they can take money out and spend it on their lifestyle at a period in time when tax rates are likely to be dramatically higher than they are today. The immediate and most obvious impact of the new rate is that maximum non-MEC premiums increase dramatically. What does that mean? That means you're going to be able to put a lot more money into a life insurance policy for the same death benefit. In other words, if you can think back to the analogy from The Power of Zero, where I talk about a life insurance policy a little bit like an ATM, whether you take $20 out of the ATM or $200 out of the ATM, they're still going to charge you $3. So the best deal is to just take the full $200, $300, whatever the maximum amount is that you can take out of the life insurance policy, or pardon me, out of the ATM, whatever that maximum amount is, that's the amount you can take out. You should take out because that $3 charge as a percentage of the, say, $300 distribution is going to be relatively small. Whereas if you only take $20 out of the ATM, then that 3% represents a much higher percentage of the overall distribution. The same thing holds true for a life insurance policy. The expenses in these policies are relatively fixed. You want to put in as much money as you can. What the IRS has just said with this new bill that got passed in the waning hours of 2020 is that you can put a lot more money into these programs and have those expenses stay relatively fixed. What are we talking about here? For those of you who are between 40 and 55, this amounts to an increase in the maximum non-MEC premiums. In other words, what you're putting in right up to what the IRS allows you to put in, the limits, without it becoming a taxable event. That amount that you're putting in has increased anywhere from 60 to 100%. What does that mean? That means you can put between 60 and 100% more premium per dollar of death benefit without triggering MEC status, modified endowment contract. You do not want these, if you're hoping to preserve the tax-free status of these vehicles, you do not want to turn this into a modified endowment contract, because then distributions become taxable as ordinary income. Last in, first out. So the bottom line is that means that these policies are going to be more efficient. More money is going to be going into these policies relative to the cost of insurance charges. Bobby Samuelson gives an example. He's run some illustrations on the new amounts. This is based on a 45-year-old preferred male non-smoker with a $1 million death benefit using a guideline premium test and using a death benefit option 2, and then switching to option 1 and reducing the face amount in the 8th year. So in other words, it's a pure cash value accumulation play. He uses a 5% illustrated rate of return. And under the current scenario, in other words, prior to the passage of this latest bill, you could put in $39,505 without turning this policy into a modified endowment contract. So given a 5% illustration rate, after 50 years, the internal rate of return was 4.15%, meaning that the cost per year, averaged over the life of the program to up to that point was 4.15%. Okay. Not bad. 4.15% tax-free feels like 7% taxable, and without taking any more risk than what you're accustomed to taking in your stock, in your checking account or savings account. That's a pretty safe and productive way to grow at least a portion of your cash. Take a look at the new scenario using that 2% hard-coded rate under 7702. You are now able to put in $72,951. So instead of being able to put in only $39,505 to avoid the MEC, you can now put in up to $72,951 and still maintain that preferential tax-free treatment. It takes the internal rate of return all the way up to 4.49% in year 50. That's a big deal. That is going to dramatically increase the distributions that you can take over the life of the program. All right, so what's the bottom line here? What is the net result of this legislation, this Christmas miracle, if you will, that was snuck in at the very last minute? All policies will now have more efficient cash value growth, which means that the LIRP is an even more attractive alternative for those who are using it as an accumulation and distribution tool, particularly if interest rates stay low for the foreseeable future. I happen to believe that the interest rates won't be able to stay long forever because people are going to stop. Other countries are going to stop loaning us money because we're going to start experiencing sovereign debt crisis, which basically means that people will stop loaning us money at current interest rates because they don't think we're going to pay it back. And to take on the higher risk of loaning us money in our increasingly precarious financial state, they're going to require that we pay them more. Therefore, interest rates will have to go up. So, long and short of it is we should feel better and more optimistic about LIRPs now than we ever have. In short, this is nothing short of a Christmas miracle. Who do we have to thank for this? There's a couple of groups that have the financial services industry's best interests at heart. That's the ACLI and Finesco. Both of those people recognize that the high interest rates that were baked into that 77OT tax code were imperiling our industry. And they were able to persuade legislators to lower it to 2% and then tie it to interest rates moving forward. This is a big deal. This will not affect any of your LIRPs that are currently in force. This will affect LIRPs moving forward. You could make the argument that if you have an existing LIRP and you raise the death benefit on that existing LIRP, that could potentially, the increased death benefit portion of the old policy could be subject to the new rules. So that's a possibility. We still don't know 100% if that's the case. A lot of good news. This is really helping the LIRP and the LIRP industry for those who are using the LIRP as an accumulation tool, for those that are using the LIRP as a way to safeguard against long-term care risk. This means that the LIRP is an even more attractive alternative. So stay tuned for this. We're going to be having conversations about this probably for the next 6 months. So I'll bring you new updates as we learn more. This is a very new thing. We'll give you more updates as we learn more. But once again, great news for those of you who have LIRPs, who are contemplating getting LIRPs, or who help position LIRPs to maximize the tax-free benefits for your clients. Anyway, thanks for being on the show today. Not a super long podcast today, but I wanted to sneak this in, particularly, hopefully you guys got a lot out of the podcast for the last 2 weeks with David Walker. I think David Walker is one of the smartest men on the planet. He understands the fiscal condition of our nation better than just about anyone else on the planet. So hope you enjoyed that. Hope you got a lot of benefit out of this one, and we look forward to chatting with you same time next week. Talk to you soon.